Good morning and welcome to Money Control. Well, today morning, the mood is truly optimistic on the Lal Street. We are firing, it seems, on all cylinders. We had a great set of numbers on the GDP on Friday, and today morning, a surprise on the assembly elections. Again, a reason for cheer. I have with me as very special guest, Rashesh Shah, founder and CEO of Edelweiss Group. Rashesh, wonderful to have you this morning.
Hi, Mahalakshmi. Thank you. Thank you for having me.
So first of all, I shouldn't ask if it was a surprise. How big a surprise was this assembly election outcome for you?
I think after the exit polls, I think most people believed that MP and maybe Rajasthan was going to BJP, but them getting Chhattisgarh also so clearly and so strongly has been a positive surprise. So it just underscores the fact that a lot of things this government is doing has worked well, and the Prime Minister's, the attractiveness for the voters is very strong. So that augurs well. See, investors have always been, they want stability. They want certainty. So if this gives more certainty for the elections for 2024, that will be a good thing, especially for the foreign investors.
Absolutely. So, as we go into general election, Rashesh, what do you think this means exactly for businesses and markets? Because obviously, even if it were the state election results were, did not pan out the way it has panned out, the markets would have perhaps shrugged it off, saying that, voters usually vote differently for central elections, and there is a very good chance that the, people vote for continuity. Now that it looks like that uncertainty also has somewhat gone away. Therefore, what does it mean for for businesses? Do you think some kind of front ending of capex happening? What do you think?
A lot of the businesses in India are looking at expanding, but instead of capex, a lot of them have been acquiring. You must have seen Ultratech acquired Kesoram last week and all that. So I think people are wanting to grow, wanting to expand, but they want to buy existing businesses, existing facilities. Greenfield capex is still a little bit way away. We are seeing more brownfield, and we are seeing more M&A happening because companies want a payoff a lot faster. So I think it's still maybe not just dependent on elections, but maybe another 18 months away, where really greenfield capex will start, where people will put up new cement plants, where people will put up new steel plants. We are not seeing that happening yet. New roads are not being developed. Existing roads are being expanded, extended. All this is going on. So currently, the entire growth is largely in terms of brownfield and acquisition of existing assets.
But why is that happening, Rashesh? I mean, if there is certainty and we all believe in, capacity building and growth over the next few years, what is the wait for? Because, if you were to expand capacities in power, cement, whatever it is, if capex doesn't happen now, you're obviously creating some kind of limitation going into 1 or 2 years. Or is there some kind of skepticism or caution in the air that keeps people from putting or committing to new capex?
So I think new greenfield capex, there is some uncertainty. There have always been cost overruns and time overruns and approval processes in India. So that has always been part of that in India. And if you do that with borrowed money, see, ultimately every new project will require equity and debt. So currently, if you have to use any borrowed money, you want greater cash flow certainty, which you get when you buy an existing asset or when you buy something brownfield where the payoff is much faster. If you want to really put up greenfield, and if you are very, very careful, then you will have to put it with only equity, which is not a good, efficient capital structure. So I think putting a new greenfield project with borrowed money is still some time away because people have been scarred. If you've seen last few years, any borrowing has come back to haunt people. People have said they will reduce debt. Even today, corporates are holding more cash than they need, and they want immediate payoff. So I think currently, the animal spirits are coming back. There is a little bit of growth hunger coming back, but there is also the need for quicker payoff. I think we are still 18 months away where these opportunities will go away. And that is where people will say, you know what, I will now have to take more risk. Maybe I'll tweak my capital structure, put more equity, maybe take more structured finance rather than bank loan to put up a new greenfield project. And that is where I think real capex will start. Until then, we are currently very dependent on government capex and government spending. If you see, even the GDP numbers are very encouraging, but if you look at private consumption and private capex, it's still a matter of concern
Yeah.
because hunger for growth has come back, risk appetite has come back, but risk appetite with borrowed money has not come back for corporates.
Sure. And how do you see this piece panning out over the next, 2 to 4 quarters, the consumption piece? I'm also asking you in the context of, in the run up to the election, do you see any kind of pivot in the way government spends? Would they prioritize investments more? Would they prioritize consumption more? Because now there is no great political compulsion in terms of how what you need to do, populist moves and stuff like that. It doesn't look like we are in that kind of political climate.
All of us believe that though the first half GDP growth has been good, we've been closer to 7.5, 7.6. For the year, India will still end up being at 6.5. So by extrapolation of that, you see the second half of this year, we should be at between 5.5 to about 6% growth. So growth will slow down because government capex will slow down. As we approach election, government capex always slows down. Private consumption will also slow down even further because of the new RBI guidelines. Because the problem has been a lot of consumption has also been on borrowed money. So as I said earlier, corporates are hesitant to borrow, but individuals are happy to borrow and use it for consumption. But that will also come down in the next 5 or 6 months. So I do think there is some GDP growth moderation happening until the elections, and it is post-election. That's why I'm saying new capex will be 18 months away because we will see a little bit of slowdown. Global slowdown is also happening, and exports are slowing down because of that. So private consumption, private capex, exports, all these are slowing down. Government spending is what is keeping the engine going, and that will continue maybe for another quarter. But after December, you would definitely see a slowdown in that also.
Okay, so the trend over the last few quarters has been that most of the forecasters on the street, whether it is equity analysts or economists, they have actually been far more conservative than RBI and government, and the ultimate numbers have always been a beat over street consensus expectation. You think that will reverse over the next, starting next year?
I think it will get moderated away. But again, anything you look at. For anything more than 2 quarters, you should be careful about inflation. The biggest joker in the pack is inflation because RBI will act on inflation. They have said that. So if oil prices remain stable, all of that, I think India is now stable at a 6.5% growth rate. We have enough savings, we have enough consumption and enough capex requirement to sustain a 6.5% growth. The key real difference will be if we do this smartly, we can take it up to 7.5, 8, or if we stumble, it will come down to 5.5. So I think a 5.5 is a bad outcome. A 6.5 for the next 3 years is a given outcome. A 7.5 will be a great outcome.
So what kind of conditions would you expect for a 7% outcome and a 5.5% outcome? Would you worry about food inflation?
Yeah, so I think between 5 and 7, inflation is the biggest factor. The second factor would be global growth rate. If global slowdown is very significant and it starts affecting export on the margin, that can shave off a little bit. Third is the credit market conditions in India. Liquidity has been tight. RBI has also kept it tight with OMOs and all that. So I think even that will act as a brake to the growth. So I would say good benign liquidity conditions, stable inflation, maybe if not falling very sharply, but stable inflation and stable global condition will take us to 7, 7.5. Otherwise, we will be at about 6.5. And if, let us say, there is a bad monsoon and inflation and food prices are high and RBI does either increase rates or put brakes on liquidity, it can take us under 6% also.
Sure. One more point on, you talked about this brownfield expansion being preferred over greenfield expansions. a lot of deals have happened, a lot of promoter block sales have happened through the course of this year. And if you look at the primary markets also, a substantial chunk of, issuances that are coming are all off of a sale. Does it really inspire confidence in growth?
Yeah, I think, all of us in capital markets believe that good equity markets should stoke, risk appetite, animal spirits, and people should then raise money for capital formation. As I said, capital formation is not happening. Capital reallocation is happening. People are reallocating capital. People are wanting more predictable cash return kind of outcome. So even promoters in the last 1 year, promoters have sold almost about 50,000 crores worth of blocks. So insiders have sold almost 1,000 crores a week as what has happened over there. A lot of that has gone into mutual funds, has gone into yielding assets and all that. So people are still not taking greenfield risk because that level of animal spirits risk taking, because greenfield will also require comfort with debt. And we are still not comfortable with debt because of what happened in the last 5 years. I think most people are averse to borrowing money to take risk in the corporate sector.
Right. Rashesh, over the last 1.5 years, we have constantly been saying that, we are at the upper end of the valuation band in terms of, markets. And deals, of course, have been momentum has been fairly good. Do you see valuation becoming a barrier to more deals going into next year? And what does that mean overall for stock prices?
Actually, India has not been that sensitive to valuation. India has been more sensitive to growth. So, as I said, if the GDP growth is, above 7% and the growth spirit is back, I think the valuation argument will start becoming a much smaller argument. India, most people look at liquidity and growth as a key driver to their actions on investment, not valuation. The foreigners are more driven by valuation as compared to liquidity and growth, but Indian investors, Indian corporates are more driven by liquidity and growth rather than valuation, and that is proven true over the years. And India will always remain expensive because India has a lot of local capital now coming into the markets. So it's very unlikely that, with SIP at 18,000 crores a month, there is very, very strong local flows which will keep the market expensive, because it's not that Indian household can go and invest abroad or they can buy other markets. They invest in India. So the kind of flows we are seeing, the kind of household savings which are there, that will keep the market valuation fairly stable. And that will not actually be a strong deterrent for anybody. Growth and liquidity availability are the main factors.
Fair enough. And how do you see flows, Rashesh? Going into next year, I mean, usually, a lot of foreign investors abstain from taking these kind of large event risk, So after these assembly elections, do you think there will be some kind of FOMO and front ending of investments from foreign investors, or they would still not be too much action on that count and people would want to skip this event risk and then jump on to, taking those calls post-election?
We have seen foreigners withdrawing money from India for the last couple of years, and largely because as US interest rates have gone up, the US market has become more attractive from a yield point of view, and everybody believed that the rupee may go down, and although it's not gone down, it's been fairly stable. As a result of that, as long as US interest rates were going up, money was flowing out of India. I think this event over the weekend, the election results, will ensure that foreigners will not withdraw money as much. I mean, when we talk to investors, we are becoming fairly clear that people may not still bring a lot of money in India because there are two factors at play. One is India's stability, which has improved with the election results, and the second is interest rates globally. The moment interest rates globally either come down or there's a feeling that they will start to come down, I think there'll be a lot of inflows into India. Until then, outflows have stopped, which has been happening for the last 2 years. The additional inflow will come in a much smaller way for the next maybe year or so. And the key catalyst is not going to be election results anymore. The key catalyst is going to be the US interest rates now.
Fair enough. And what is your own sense in terms of, have we peaked out on US Fed rates, or you think there could be negative surprises there?
I think most people are now strongly believing that the US Fed has I think peaked out. They are not saying it yet, and that is more important, because not only what everybody feels, but what they say is equally important.
Right.
If you ask me personally, I think they have picked out. I think inflation has got stabilized all over the world, and that augurs well for India. But maybe it will take another 3 to 6 months for the US Fed to officially indicate that the interest rates have peaked out, and they will now start looking at when they should start cutting. So even if they don't cut before 2025, that is okay. As long as it's not going up and the next move is going to be cut in interest rate, that will be good for India.
Fair enough. And Rashesh, you might be talking to a lot of family offices and looking at your own portfolio. What is the sentiment like amongst high net worth individuals? Because this is definitely one category which has been very vibrant. A lot of money has come into stock markets from this category of investors. Now with interest rates peaking out, do you think a lot of money is looking towards debt, prioritizing debt over equity?
I would say so. I think a lot of investors are now allocating equally between what we call yield assets and
Right.
equity assets, because I think equity is reasonably priced, and yield is it's a good time to lock in yield. So we are seeing a lot of investors wanting to lock in yield, but they don't want to lock in for 1 or 2 years. They want to lock in for 3 to 5 years. So if they get something which is giving them 11, 12, 13, 14% over 5 years, there is a lot of demand for those kind of products, like some of the alternatives funds and AIFs and private credit funds are largely in vogue because of that, because people want to lock in high yield over a longer term, because everybody believes this is as good as it gets. But they don't want to lock in 8% rates. They want to lock in at least 11, 12 and above kind of rates. So any product, any opportunity on the yield side. On equity side, I think people are selective. And currently, I think most HNIs would be 50-50 between equity and yielding assets.
And incremental money over the next year would go into debt or equity. What is your sense?
I think it will be half and half, because equity will always remain attractive. But I think if maybe the last year it was 70% equity, 30% debt, and now it's gone to 50-50, where people are saying, I want to lock in yield. Until a year ago, people are not clear whether interest rates will still go up or not. So there was not as much confidence on the debt and the yield side. But now there is a lot of, so that is why we are seeing a lot of interest in InvITs and REITs and all. People want to lock in. But of course, at 8-9%, it's not as attractive. Then equity market wins if you get 8-9% product. But if you get 11-12% investment opportunities, then HNIs and family offices are very keen to look at those.
Fair enough. And what is your sense, Rashesh, on the unsecured lending piece? Obviously, RBI is trying to put brakes on that, and retail NPAs traditionally in India has never played out. I mean, the retail cycle has never played out because households didn't leverage to this extent any time in the past. Do you see any negative surprises there?
Well, I think RBI has obviously put brakes early on at the right time, because all this can grow very fast and can get out of hand. And RBI has always been very conservative, try to get ahead of the curve. And it's a good thing. The total quantum is still pretty small. The entire unsecured loan is not more than, it's under 1% of the total credit book for the bank. So if you look at a few years ago, when banks' wholesale book was almost 11-12% of the banking assets were restructured or stressed, I don't think the unsecured book can present that quantum of risk. But it has other fallout effects from the political, because if there are a lot of how they bought, because unsecured loans interest rates are very high, so it's easy to get into debt trap and keep on rolling over higher interest rate and all. So RBI is more focused on making sure this doesn't get out of hand. It has fueled some amount of growth for the last year with household borrowing, and post COVID, a lot of the middle income and the lower middle income households, their balance sheets have got affected, and they've relied more on debt. But Currently, I don't think it's a problem. I don't think it will become a problem thanks to RBI putting brakes out there. And it is something good, but I think ultimately retail credit is the way to, Indian economy will also grow like all other economies. We have always had only corporate debt. The balance of corporate and retail debt will be a good thing, but it should happen in stages as your ecosystem also catches up, credit history and your collection mechanisms. So I think if this small break acts as a stabilizing factor, it will be a good thing.
Sure. Rashesh, one big picture question and one last question. What is the sense you get on jobs growth? Because now everybody is talking about AI, and over the past year, you haven't seen much hiring on the IT front, and in several sectors, jobs growth may get challenged. For example, autos and a whole portion of sectors that could be challenged by China. How do what is your take on how big a challenge could jobs growth be over the next 3-5 years? And what does that mean for the consumption piece?
I think AI in the next 3 to 5 years will not affect India jobs as much because our jobs are, I mean, if you look at the total 500 million jobs in India, 250 are in agriculture. So those will unlikely get affected much by AI, but of course they will get affected much more by government schemes and all. And what we saw in the MP elections is also that the agri jobs has actually played a big role because MP has been growing that pretty well. Out of the other 250 non-agri jobs, I think retail and construction play a big role. So those are also not going to get disintermediated by AI and IT, retail jobs and construction jobs. So I think on the whole, it will affect India on the margin. It will obviously affect high-paying jobs. But I think in the next short term, AI will be more an enabler for India because a lot of the jobs in financial services and IT the productivity will hopefully go up if we use this well. So I don't see a big threat to jobs for India in the next 3 to 5 years. Over the next 20 years, I think your guess is as good as mine, how much change AI will make into the way we live and the way we work. But in the next 3 to 5 years, India, because our jobs are of a very different kind.
Fair enough. And how do you read into this real estate growth, Rashesh? Because from a stock market perspective, last 1 year, real estate has shown exceptional performance, 60% growth on the index. And luxury houses are, selling like hotcakes. Is this a temporary phenomena, or do you see a large cyclical up move in real estate from here on?
If you look at from 2012 onwards, real estate has been underperforming. I mean, from 12 to 21, almost 8-9 years, real estate underperformed in India. So that, in a way, is helping because there is some stability coming back. Obviously, the concerning fact is the upper end of the market is doing very well. The affordable is still a lot more subdued because what has happened post-COVID, there has been, what people call the K-shaped recovery. The richer people, the upper end of the income scale, have been doing well. So they are buying bigger homes, they are buying 3-bedroom, 4-bedroom homes, expensive houses. But the middle and the lower income has suffered. They've been also borrowing for consumption in the last few years. And until those balance sheets are repaired. So what happened post-COVID, Mahalakshmi, is RBI balance sheet has been strong. Government balance sheet has also become strong because government didn't spend too much money on stimulus in COVID. The corporate balance sheets have become stronger also, corporates also. The bank balance sheets have become stronger. But the household, especially the rural household and the middle income household and below, their balance sheets have got weaker. So out of all the 5 balance sheets, 4 have got stronger, which is what is driving a lot of confidence in India. But the one which really supports consumption is this part. And that is the current worry is that the lower income and the rural income has to grow for India's real growth engine to start chugging along again. Otherwise, corporate balance sheets are best they have ever been. Bank balance sheets have been the best they ever been.
Yeah.
Government is doing well. RBI has also got a strong, reserves are almost 600 billion. So this is the only area of worry. And with high inflation, this is the one balance sheet that comes under more pressure. And again, as inflation comes down, hopefully the household balance sheets will also get repaired. And as they get repaired, I think more sustainable growth can come back in India.
Sure. One last question, Rashesh. When you look at your own portfolio of businesses, distress assets, real estate, alternatives, wealth, broking, all of it, uh, where where are you spending most time worrying? What are you most bullish about?
Actually, all our businesses, I mean, all businesses have different issues, different challenges they are facing, but we have these 8 businesses. They've all done well. I think from a growth point of view, as inflation comes down, as interest rates stabilize, and people look at long term, I do think insurance for the next 10 to 15 years is a clear need for household health insurance, car insurance, life insurance as a savings product. All of those retirement savings, all of that are becoming also very, very important. So we are fairly bullish on that. Our asset management business are doing well because that is also becoming the need. So Mahalakshmi, the larger underlying issue is India's savings have improved a lot. In fact, I think we are now getting towards becoming capital surplus because at a $4 trillion economy, household savings will be closer to $1 trillion. But in their household savings, the financial household savings, how they invested on a long-term basis is the biggest play. But we should remember that at $4 trillion, household savings will be closer to $1 trillion. This is the size of Indian economy in 2007-8. So India has truly got scale. India household savings have really come of age and channelizing those savings into investments. So, there is an old adage, which is that Indians know how to save, but Indians are learning how to invest. Is going to play out over the next 18 years. Indians have learned to invest in equity markets and all, but investing in these yield products, investing in insurance, investing in other products is where the larger, bigger opportunity is emerging.
One related question on Jio's entry. Do you think there is going to be huge disruption? How do you view it?
I think disruption is a strong word. It will give a strong fillip to the market, especially on the retail credit side, because they obviously have a strong balance sheet. They have strong customer base, and they have obviously ability to scale very fast. So I think on the retail credit, that will be a big play, whether it's on personal loans or car, a big role. They might also, I mean, I don't know what the plans are. I read the same papers as everybody else. They might also do a lot of investing in health insurance, because health insurance after COVID has become one big area where the need is growing faster than the market's ability to catch up with the need. And health insurance is one big area where a player like Reliance can truly make an impact. So I would not call it disruption, but I think they would have a big impact on the market, because disruption in the market in financial services is not as big. I mean, we have had changes, we have had growth and all, but I think bringing efficiency, bringing cost effectiveness, bringing scale is where a player like Reliance will play a big role.
Okay. On that note, thank you so much, Rashesh. Wonderful talking to you as always.
Thank you. Thank you very much. Really enjoyed it. Bye.
Thank you. Bye.